But hopefully, I sent out an email. Hopefully, you got it. That has the stuff for the class. It's also in. Oh, that's not it. If you go down class handouts, the file should all be in there too. Hopefully, I put them all in there. I think I did. But they're the exact same ones I sent out, so there's nothing. There's no reason to have both of them. I guess an easier way to put it. Okay, it's 6 o'clock, so we'll go ahead and get started. This class, just so you know, is recorded. So if you can't make the class for some reason, that's fine. It'll be recorded and it'll be in Blackboard. I'll show you where in Blackboard it'll be. Hold on a second. Under recorded meetings in Blackboard.
Oh, okay.
Yeah, I'll show you a different class that has one already in it. How about that? So you have recorded meetings. So the meetings will always be recorded and put into Blackboard, and you just have to click on either one of these. Will get you there. And it's a YouTube video that will come up. So in recorded Zoom meeting, so underneath the Zoom meeting link, which is, you already have this, or you wouldn't be we wouldn't be talking to each other right now. But underneath there, the recorded. So every Zoom meeting will be recorded, and it takes about a day to get up. Just so you know, there's actually. It takes a while for it has to go through 3 renderings basically before it'll be up. So it usually takes a while, and the biggest uncertainty is in YouTube, because YouTube will render it, and sometimes it takes 15 minutes, sometimes it takes 6 hours. It's just I don't know how it works out exactly, but just so you know that it takes a little while, but certainly within 24 hours the Zoom meetings will be up. Okay, which one? I think it's this one. Okay. So let's go ahead and get started. And first thing we're going to do today, you got to add something. The syllabus. So today we're going to go over the syllabus. Second thing we're going to do is go over some of the kind of general definitions in accounting. There's actually 2 handouts there. And then the real one we're going to work on, those, the chapter 1 handout. We should finish it. If we do, we do. If we don't, we don't. But it should be pretty close anyways. And if we do finish it, then I'll go through how we submit the handout. So this is the agenda for today. All right, and first things first, let's go to the syllabus. Contact information, office hours. If you want to meet some other time other than the class time, let me know. I'm available most times. I got a night class on Thursdays, so this is Thursday, Tuesdays and Thursdays. So I can't meet those times, but almost any other time we can make an appointment. We can figure out a time to meet. The textbook. The textbook, you can use any version in this class. What I mean by that, you can buy it used. You can use. You can go through the school and get the online one, the ebook. You can. There's PDF versions of it out there, I'm sure. It's been around a couple of years, so you can probably pick, if you want to use get a hardcover copy of it, you can probably pick it up used fairly cheap. So any version you have for this class. And the only caveat or warning that I'll give you is that this same textbook is used for accounting 211. So if in 211 you have a teacher that relies heavily on, say, the textbook materials, you may have to get the access code. And you get the access code by clicking. You can actually get it cheaper usually than the bookstore, but you can get the access code by going through the link in Blackboard to get it. But again, in this class, I don't rely heavily on it. It's the textbook is not the course. It's we do some of the problems or some of the materials in there that we use, but it's not, you know, the entire course. And the reason I do that is it just, people usually do better kind of going through the way that I tend to go through it. All of these classes, you can do 100% online. They'll actually build the class for you. And the problem with those classes is about half the people fail, which is not, I don't think it's really good teaching. So anyway, I generally do a mixture of handouts, practice exams, textbook problems, and then we have exams, and that's kind of how we do it. So in this class, long story short, in this class, any version of the textbook is fine. Again, you get into 211, you may have an instructor that, again, relies more heavily on the material, on the online materials from the textbook, and they may require you to have it. Okay, blah, blah, blah. You can read that stuff if you want. Okay, so here's how the class is basically graded. If you go into page 2, so near the top of page 2, handouts, textbook problems, and practice exams are 20% of the grade. And basically we have an exam after every chapter. And but the handouts that we do, the textbook problems, the practice exams, 20%, and the exams themselves are 8% of the grade. So the exams are kind of heavy. So you want to make sure you get all the exams. If you're not going to turn something in, don't have it be an exam. Turn all the exams in. The reason why we do this, the reason why we have exams after each chapter, there's 2 reasons for it. First of all, people generally retain the information a lot better if you have more exams, shorter exams more often. And second of all, the grades are usually higher. On the exam themselves, not only they retain the information longer, but the exams themselves, they don't do better on it. So that's kind of the reason why we do this. So after every chapter, we're going to have an exam. Zoom meetings, blah, blah, blah. Oh, course files. I talked a little bit about this before we started doing this, but if you go in Blackboard to class handouts, so not only do I email this stuff out to you guys, but it's also in class handouts. So if you didn't get the email or whatever the situation is, the same stuff is available in Blackboard under course files, or no, class handouts, I'm sorry. I renamed it this quarter, or this semester. So class handouts. Do I have that in here? What did I put in here? This should be, this is a class handouts. Maybe I should change, I don't know. Darn it, try to make it easier and I goofed it up. Okay. Now, how you submit stuff to be graded. You submit stuff in the submit handouts and to be graded here. And we will have this, I'll show you how this is. I'll put it in right now. So this is what you're going to do. So this is how you're going to submit assignments. I'm going to make the assignment for the chapter 1 handout. We'll do it right in front of you. You can see all the magic that happens. Okay, so okay, so I'm setting this up as an assignment. I'm going to make the due date next Friday. If we don't get done with it today, I'll back that up. But usually I give about a week for people to turn it in. Grading, 100%. Submission details, then this is important. You have unlimited attempts to turn this in. And the highest grade will be accepted. So you have unlimited attempts. And this will get into how we turn in the assignments in a second here. And oops, move something here. So when we finish the chapter 1 handout, you're going to click on this and it'll tell you the due date. And you can write the submission, but more likely you're going to attach a file and submit it, and that's it. So you submit stuff in the submit handouts and exams to be graded. All right, so let's get back to most of these documents we're going to do are we're going to be completed in the Zoom meetings. So if you do miss a Zoom meeting, look at the recorded one, and it usually will walk you through whatever the handout is or whatever the problems are doing. Okay, so how do you submit it? Well, what form? Well, let's go down here. You can fill it in Word and submit it that way. In other words, just do it right into the Word document that we're using. You can fill in a PDF document. Fill in the PDF document, do the insert text thing, and that's fine too. And those are probably the most common. Most common people usually type it right into the document. Now, you don't have to do that. You can print out the document and write it in by hand, and then take pictures of it or scan it, either one. So you write out by hand. You can also just use notebook paper. I was going to hold a notebook, but you guys probably know what a notebook looks like, so I probably don't need to do that. So if you just want to use a notebook or some kind of paper and write it out, and you don't have to rewrite the problems, by the way, just the answers. If you're using a notebook, just put in the answers, and scan that or take pictures of it and submit it. So any way you do these handouts, basically, I'm fine with. Okay, now there are two things that are not good. They're not deal breakers, but they're not fun to deal with in Blackboard. Okay, you get a bunch of you take 5 pictures of the handout and you want to submit them. Do not put them into a zip file. I know you say, okay, well, a zip file, is easy to use. It can do it. That's true, but Blackboard has a problem with zip files. It doesn't really read those. And same thing with if you're an Apple user. Blackboard cannot process page files. Page files are basically zip files that are in for Apple people. So zip files and page files are no good in Blackboard. I can still do it, but what I basically have to do is download it to a file and then pull all the documents out and then go back and put the grades in. And just as a matter of convenience, I do these last because these I take 15 minutes, and in 15 minutes I could grade 10 students or 5 students stuff and get 5 students or grade faster than for 1 student. So anyway, don't submit. So if you just submit the pictures, and you can submit 10 pictures, 20 pictures, whatever you want to do. You can do that. It's unlimited. So you can put those in. If you are an Apple user, you have another really great thing, and that is that you can actually convert the page files to PDF files. So if you are an Apple user, there's a good program that they have that will actually convert the page files into PDF files, and then you can just submit that. So anyway, page files and zip files are unfriendly in Blackboard. Another thing just to mention, and this goes throughout all your classes, and that is, for whatever reason, the Blackboard app for smartphone. What kind of formatting do I have here? The Blackboard app for smartphones sometimes cannot submit assignments. So be careful. And this is not just for our class. This is for all the classes of Blackboard. It's a problem. So if you're submitting things, and either in this class or in any other class, and they're not getting them, it could be the app itself. So the app in the phones is sometimes not as good as it really should be, especially in this day and age. But for whatever reason, it doesn't. And even more frustrating than it not entering stuff, the error that it gives is very frustrating for instructors because it'll actually show as loading. You know, the little clock that goes around and says, you know, it's loading. It'll do that for months. And as an instructor, we can't stop it because it says, no, we're loading something. And so you can't get a grade and you can't stop it. So if you're having problems submitting things, that Blackboard app is not always the best. So be aware of that. Now, if you're using it and it works fine, that's fine, but it does happen. Okay. Any question on this? Okay, so you can submit it any way you want, and there's nothing wrong with submitting 10, pictures of notebook paper. That's fine. And again, if you're doing it in notebook, you do not have to rewrite. Don't rewrite the problems, and then you just put the answers in the notebook. I can, I know what the handouts are. Grades for the class. These are pretty much the standard grades for the university. Course by week. This is not set in stone, but it's kind of what we're going to follow. And the only odd one coming up is this. You'll notice that chapter 4 is going to come before chapter 3. And that's just because it makes more sense to do it that way. So chapter 4 will come before chapter 3. Other than that, we'll kind of march along here. And this is just this is what you have in all the classes. A lot of stuff in here that is good, especially things like mental health stuff and where you can get help for different things. A lot of that information is included in here. So ideally, you won't have to go searching around the website trying to find something. That most of the stuff that you would really want to look into would be right here in the syllabus. And this is for all the classes at Roosevelt. So almost virtually any class, I can't speak for other instructors, but virtually any class, their syllabi is supposed to have all those policies in there. So you should be able to look up the stuff fairly quickly. I'm not going to go through them just because it doesn't pertain necessarily to everyone in the class, but certainly you can. Any questions? No? All right. Well, then we will go ahead and get started in doing accounting. Okay, I tell you what, do me this favor, open up the handout that says definitions, chapter 1 definitions. And this is sort of like the chicken and the egg thing. It's kind of hard. It's hard to do the financial statements without knowing what the definition of these accounts are. It's also difficult to know what these accounts are without doing the financial statements, but I'm going to try doing the definitions first. I always did them second, and I've never felt the warm fuzzies doing it that way. So I'm going to try doing the definitions first and see if that helps. I've taught a class like this well over 100 times, but you're always trying to tweak stuff. Okay.
There was a question in the chat box. I'm sorry, let me not interrupt you. But there a question from a student. I'm not sure if you saw it.
Yeah, do we have weekly assignments? We only turn in things that we're finished. There is no list of X, Y, and Z has to be turned in week 1, you know, whatever has to be turned in week 2 or anything like that. We basically bounce along with the class that as we go through an assignment, whatever it is, a handout, practice exam, textbook problem, when we're done with it, we turn it in. And if you want to know though, if you say, okay, well, I want to know what is due for next week, if you go into the submit handouts and exams to be graded, if you go in here, it will let you know. You know, whatever's in here is what you need to turn in, and you can look it up. I'm going to delete this one. So whatever's in here, you can look it up. Now, I might, this one, I don't know, if we finish it, we'll be able to use, click on it, it'll tell what the due date is. So if you want to know what is due, click on submit handouts and exams to be graded. No, that's a good question. All right. So let's start going through some of the definitions. Sorry, I moved my camera a little bit. Revenues. If you're looking at a business and you're trying to think about how it's profitable, and this is sort of something that is, I think everybody understands. It's just that we kind of put it into a more formal context, more formal format. If you're in a business, you're going to look at things that come in, money that comes in versus money that goes out. And hopefully what comes in is more than what goes out. Right? I mean, I think that's, everybody understands that. We have kind of special ways of naming those accounts. The money coming in is, we call them revenues. So this is so revenues are money coming in. And we compare those to expenses and costs, and this is, as you may have guessed, money going out. So revenues are money coming in. It's a little bit bigger. And expenses are money going out. Now, in accounting, nothing is that simple. We actually have a whole bunch of different things that are basically revenue, a whole bunch of different names for them. Revenues could be called revenues, money coming in, you know, just like we have for the definition up here. Some things are called earned revenues. And that is basically goes to the definition that revenues are earned, and we'll talk about more about that later. Sales are the same thing as revenue. Many companies will show those interchangeably, sales and revenues. You know, so again, these are all exactly the same thing. These are all just money coming in. And they're basically what you earn from the customers. So you could earn money from the customers by selling them something. Walmart, they sell goods. That's how they earn their money. They sell goods to people. It could be doing a service. It could be, well, like Comcast. You know, they have internet service. They sell a service. And so it could be any number of things. And whatever a company does to make money from its customers, that's a revenue. And so as you go through here, you know, well, these are all the same thing for revenue. The only ones that are unusual are these down here. When you see something like fees earned or commissions earned, and that goes to this. I should make these. I should make these green. I should make these yellow. Confusing. Oops. Whenever you see the term earned, it's going to be a revenue. So if there is a wacky account, but it has that earned on it, it's the revenue. And I know that's strange, but here's another thing about that. We count revenues when we earn them, not necessarily when the cash comes in. And we'll talk more about that later. For instance, if I mow my neighbor's yard, and I say, okay, you know, I'll mow your yard for $20. Okay, you know, they agree to it. I mow the lawn, but they haven't paid me yet. I still count that as a revenue because my part is done. So I count that as a revenue. Whenever they give me the cash, you know, that's something separate. But you count revenue when you earn it, not necessarily when the cash comes in. Okay, so revenues are money coming in. Expenses and costs are money going out. I probably should put this stuff last, but we'll go over it first here. It could be that you sold them goods. So if you sold somebody something, you sold them a whatever, that this is the goods leaving the place. Here, let me show you. Stop sharing here. So for instance, let's say that I'm selling toys. Okay. So here's this toy, and I'm selling it to a customer. Now the customer comes in and buys it. Okay, and let's just say the customer buys it for $20, and maybe I paid $12 for it. Well, notice what's going to happen. They're going to give me the $20. I'm going to give them this. This is leaving the place, right? That's going away. I'm not going to have that. So this is actually leaving. This would be cost of goods sold. Whatever I paid for this, it's going. So it's not really cash leaving the place, but it's, you know, annoying me, it rattles. But anyway, so that's, you know, kind of what we're talking about when we talk about these cost of goods sold. So it's sort of like this. So let's say I sold it for $28. I would say, let's see here. Let's get rid of all this stuff. Oh, here. Let's say that I sold this for $20. I'd have a revenue of $20. And let's say I paid $12 for it. I would have a cost of goods sold for $12. And now I'm going to ask you something that you already knew. Wait a minute, you can't see my screen. I'm being
Right.
It's like a bad ventriloquist act. I'm sorry. Okay, so let's say that I sold this thing. Say I paid $12 for it and I sold it for $20. Okay, the 20 would be money coming in. So whoever buys it hands me a 20. My cost on it is 12. Now they're going to leave with this thing. I paid $12 for it and they're leaving with it. So it's not really cash going out, but it's actually the goods are going out. So this thing that I sold that I paid $12 for that I sold for 20, that thing is leaving. Now, just intuitively, how much money did I make on that sale?
$8.
Yeah, $8. And now we didn't have to talk about anything about accounting. If I told you that bought something for 12 and sold it for 20, everyone would know you made $8 on it. But we're going to put it in kind of a formal format. And that's kind of all this is. So one of the things we're going to do is compare the revenues, the money coming in, with whatever goes out. But a lot of this is just, you know, I think everybody knows it. It's just that it's a little bit more of a formal format. Okay, expenses are money going out. Basically, supplies a little bit different. Supplies are something that we use. We'll actually get to that in chapter 3. But but any expense. So if you advertise, it's the cost of advertising. You pay insurance, the cost of insurance, repair, cost of repair equipment, whatever. Anything that you're paying money out, you know, basically is going to be an expense. Anything that you pay money out that is necessary for the business. So salaries expense, utilities expense, so on and so forth. So expenses are money going out. I'm going to skip these two because we'll get to those in a minute. I'm going to skip net income and dividends. We'll take care of in the financial statements. But I do want to go to assets. Let's go to page 2. And on page 2, we start out with assets. On page 2, we have assets. An asset is anything that has a value.
Future value.
So anything that has a value is an asset. Cash obviously has a value. Accounts receivable. This is when our customers owe us money. So let's say I mow my neighbor's lawn. My neighbor hasn't paid me yet. My neighbor owes me $20 or whatever it is. That would be an accounts receivable. Now, notice that in the future, that's going to be cash. When the customer pays, it'll be cash. So the future value will be.
Professor,
Yeah.
is it just anything that has value or that has future value?
Same thing. Yeah, current value and or future value. The reason they don't use current value is that a lot of times that might be something that is being expensed immediately. But generally speaking, yeah, anything that has a value is going to be an asset.
Thank you.
Yep. Inventory, this thing. If you buy these, it's an asset. It's something that has a value, and so inventory will be an asset. Supplies are things like cleaning stuff and that. The difference between supplies and inventory and merchandise stuff is that usually the supplies aren't. If I'm running a toy store, I'm not really going to sell cleaning, window cleaning spray, right? I mean, I'll use it. I'll buy it for the store so I can keep the place clean, but I'm not going to sell it to anybody. So the difference between supplies and merchandise or inventory is that these are generally not sold to customers. These are usually something that you keep in store to keep the place going. The wacky ones. Prepaid. When you pay for something ahead of time, it is
Asset.
an asset. The two most common ones are rent and insurance. If you pay them ahead of time, you're paying for something that you're going to get in the future, a benefit of renting the place or having covered by insurance or whatever. These are the two most common that you have to pay ahead of time, is rent and insurance. And when you do that, it counts as an asset. So if I pay insurance a year ahead of time, then it's going to be an asset until I use it up. It's going to be covered for the next year. It's a future. Okay, land, building, and equipment. Land is just land. Right, I need to write that one out, but land, real estate, property, however you want to put it. Buildings, same thing. Building, a factory, a plant, a warehouse, a garage, whatever it is. Buildings are also assets. These are generally for very long periods of time. And equipment could be regular equipment that you'd have. It could be shelving. It could be tools. It could be trucks, cars, airplanes. It could be any of that kind of stuff. And basically, when you look at a company, if you drive by like a Walmart and you look there, this is what you're going to see. You're going to see their land, their building, and you go inside, you might see them shelving and all that kind of stuff. But this is basically what you see when you are looking at a place. We also have some things that are intangible. Patents. For instance, drug companies have a huge amount of dollars in patents. And the value of the patent is not in the patent itself, is that they can actually use it and sell that drug or whatever to the public. Copyrights, computer companies all have copyright, millions and billions locked up in copyrights. entertainment companies that do music or movies and that kind of stuff. Copyrights are a huge amount of their assets. And again, it's the exclusive right to it. Okay, liabilities. This is stuff that the company owes to lenders or customers. The most common ones you're going to see are the payables. Yeah, whenever you see payable, it's a liability. So I guess I don't need to highlight all of these. You guys kind of get the point. But whenever you have a payable, and it could be to anybody. It could be payable to the bank. It could be to your own employees. You have a business, your employees work for a period of time, and then you have to pay them, right? Well, sometimes they work for 3 or 4 days or whatever. You owe them money for that period of time. So owing your employees is a very common thing to have happen. So owing them salaries or wages. And that is, here's the wacky ones down here. Unearned revenue. That's when somebody pays you ahead of time. So my neighbor wants me to mow his lawn. And I say, okay, it's $20. My neighbor pays me the $20 right away. Says, okay, here's the $20. Says, okay, I can't mow it now, but I'll mow it next week. Okay, that's fine. Here's the $20. My neighbor has paid me ahead of time. Now, that is actually a liability to me, because if I don't mow that lawn, I got to give the money back. That's what unearned revenue is. It's really not even, it's not really not revenue. It's kind of a bad term for it, but you see it all the time. But unearned revenue is really a liability. It means that somebody has paid you ahead of time. Now you haven't earned it. And until you earn it, it's a liability, because if you don't do anything, you got to give them the money back. So that's kind of an odd one. 99% of your liabilities are going to be payables, but you might run into these every now and then. Okay, and this is down here. This is also a little bit kind of kooky. The equity section, because it's a weird way of thinking of things. The business will sell ownership to investors. Right. So now if you have a company, they'll have common stock, they'll have it printed up, and they'll sell that to investors. So they'll give the investors the stock certificates, and the investors give them cash. Okay, I want to invest $5,000 in your company. I'll give them the $5,000. They'll give me $5,000 worth of stock certificates, and that's, now I'm an owner of the company. So it's sort of like it's ownership of the place. And just no paid-in capital. I don't want to go over that. It's exactly the same as common stock. We'll get to that later probably. And retained earnings, that's another thing we'll go over in the next few minutes here. So anyway, I know this is a lot. It's a lot of wacky definitions and stuff. And it's pretty dry, but it really most of the stuff is actually stuff though that most people already know. It's just that it's put in a different form. So that's the kind of weird. And if it looks very strange, it should. This is the first time you're probably seeing this, so, or most of it anyway. So, if it looks unusual, it should. For most people, it's going to be your first accounting class. So, all right. So this is kind of the definition stuff. I'm sure there are questions on this. Any questions on it? When we start using it,
I have one question. I work at a company that does cash-based accounting.
Yep.
Does it still count? So the way that you maybe I'll ask this question later. It was something I read, and it said that you have to count it within the same time period. So like the expense and the income based on like one project have to be in the same time period. And it's confusing because sometimes we get paid the next month. So I'm not quite sure how to categorize that.
Yeah, and cash basis accounting, that's one of the problems with cash basis accounting, is that they don't always match up. Just like you said, that the amount you pay out and the amount you collect for the same project might be in different periods. And that is one of the problems. There is a kind of accounting called cash basis accounting, that is absolutely correct, and they do just follow the cash for that one.
So
Again,
a lot of this stuff doesn't really apply to cash-based accounting, right?
yeah, and a lot of companies are cash-based just by their nature. If you look at something like you know, a restaurant or something like that, you know, that it isn't like you go in and have a meal and then they bill you next month for the, you know.
Right.
So a lot of it is there are businesses that are cash basis anyways, but yeah, so cash basis is a different kind of thing, and a lot of times, you know, for
Okay.
taxes and stuff like that, they do that.
Got
My,
it.
my wife's a
Okay.
therapist, and we do it on cash basis.
Okay.
So yeah.
Thank you.
Yeah. But yeah, so but the way we're going to show you, this is what they call accrual accounting, which we won't talk about really till chapter 3. But okay, so what I'm going to do is let's switch gears and let's go to the handout, the chapter 1 handout. I should just say chapter 1 handout, not definitions. And it should look like this. And we're going to talk a little bit about corporations. And corporations they're kind of unusual. You guys probably had this in other, you may have had this in other classes, but we're going to go over it. A corporation is set up as a completely separate legal entity than the owner. They're completely separate. So I can buy stock, say, in IBM, but IBM is completely separate from me. Even though I'm an owner, okay, I bought the stock, I own stock certificates, I'm, you know, an owner in IBM, it's completely separate to me. You know, if I buy stock in IBM, I can't just walk into IBM and, you know, drink the coffee and eat the donuts. You know, they're completely separate. Okay, so there is a strange thing that happens with corporations, that they are completely separate entities from their owners, and they basically can do anything that a person can do with the exception of voting. So they're completely separate from the owners in a corporation. Now, what is a corporation? A corporation is granted by a state. So they'll talk about where they're incorporated. So any state of Illinois, you can get a corporation in the state of Illinois. They also have things like limited liability corporations and all that kind of stuff. Kind of the same thing is this. But a basic corporation, though, is granted by the state. It's literally a separate person. You know, years ago, they used to have to go through the General Assembly of any state, and they would vote on it. And the state would say, okay, you can have a corporation and you have to pay us, you know, 5% of your revenues or whatever it is. But it's a completely separate from the investors. And there's something really good about that. And here's what's really good about it. I might not know anything about computers or tech, nothing, but I can invest in tech companies. So I can be an owner in tech companies without ever knowing anything about them. So there is a big advantage to having this kind of separation of the corporation and the owners. They're not all separated. You can have a one-person business that incorporates, and that one person owns all the stock, and it's still a corporation. But you know, the nice thing about corporations is that they are completely separate from the owners. Yeah, question?
Yeah, so I got a question. So I actually, so I'm a real estate agent, so I'm self-employed. I
Yeah.
just created an LLC just recently to avoid double taxation. I just had a question. So I saw stuff about an S corp. Could you just explain to me why would I want to, you know, elect to be an S corp, or what's the benefits in that?
Yeah, an S corporation. Just what we're talking about is corporations get taxed twice. They get taxed when they make income, and then they also the owners get taxed when they pay out dividends. And so anyway, there's a thing called an S corporation, and the S corporations avoid that double taxation. It still allows for a corporation, but it gets taxed more like an individual. Your LLC is like that too. It should be that you know that it limits your liability. However, it also avoids that double taxation. Sub-S corporations, they generally have a limited number of people that can be in them. They can be owners, something like 35, I think, maybe more than that now. But and as long as it's a small, it's made for smaller, usually smaller numbers of groups. Although they could be, companies could be huge. It could be billion-dollar companies and still be a sub-S. But they generally get taxed as a regular business. So a sub-S corporation is a good one to do, especially if you're going to have a number of shareholders. You know, they say up to 35 that I think it is, that you can have and still be not double taxed. But yeah, corporations also, you know, they have to talk about corporate tax. You hear in the news, they talk about corporate taxes. So they're talking about that corporations do get taxed. And then when they pay money out to the owners get taxed. So, and I'll talk about that when we get down to here in the dividends. I'll talk about that. But, okay. Yep. So articles of incorporation. These are kind of like the rules of the corporation, and these will be set up when you set up the corporation. And whatever those rules are, you're bound to follow those. The rules for so issuing stock and all that kind of stuff. There'll be rules for it. They may have one owner, and they could have millions of owners. They may be privately traded, in other words, that only few people have it, or publicly traded. I mean, anyone could buy it. Hey, I shouldn't have done that the same color. So privately traded, let's say I own a hamburger place, okay, and I want to make it into a corporation. I make it into a corporation, you know, subchapter S or just regular corporate, whatever it is. And I don't have to sell stock to anyone else. I can just keep all the stock for myself, which would make sense, right? I mean, especially if it's a smaller place. So privately traded, publicly traded companies are the really big companies usually. They're the ones you know, Walmart, Target, you know, all that kind of stuff. There's other ones that are not quite that big, but public traded companies are usually fairly good size. It takes a lot of money to get these companies there. They get listed on exchanges. They have all kinds of rules with them. But so they could be publicly traded or privately traded. For instance, IBM would be a publicly traded company. You can go buy stock on IBM. And there's nothing IBM can do about it. IBM can't say, no, we don't like you. We don't want you buying our stock. IBM can't do that. It's publicly traded. Privately traded, yeah, my hamburger stand, no, I don't like you. I'm not going to sell you my stock. Okay. And this is one of the big kind of problems that you have in, what is one of the good things, but also one of the problems of is that owners do not always participate in the management. For instance, I buy IBM stock. It does not make me a manager at IBM. Okay, so now you got to think about this for a second. Somebody else is running the place. I own it or I own part of it. I want to know what's going on with it. Now I know that the people who are running it know what's going on with it, right? They should know what's going on with it, but I don't. So, you know, there's going to be this kind of communication thing. How are they going to let people who are not in the company know how the company is doing? You know, there's that, because we don't all participate in it. We don't know, you know, that you don't know what it is. Okay. All right. Now this is kind of what we were talking about with the LLC or the subchapter S corporation. And this one is that yeah, it looks the same to me. The same call. Okay, dividends are paid to owners, but only if the dividends are declared by a corporation. So the dividend is paid to the owners, but only if the company actually declares a dividend. A company doesn't have to declare dividends. The company could say, "Look, we had a bad year. We're not declaring dividends, or we're expanding. We're going to do this expanding. We can't be paying out money now. We have to use this money for something else." So a corporation is not required to pay out dividends. Now, this is different than expenses. this is money paid to the owners. This is not money paid to keep the doors open. This is not money being paid for rent. This is not money being paid for utilities. This is money being paid to the owners. It is not necessary for the business to run with these dividend payments. Okay, so
Yes, sir.
yeah,
Please, I do not really get the last part. You said a corporation is not required to pay dividend, but who is?
the corporation itself. See, this is how they pay. They pay the owners through dividends.
So you said they pay owners dividends. And
They pay-
then you said they are not required to pay dividends. I don't really get it, please.
Yeah, dividends are paid to owners, but only if the dividends are declared. So I should explain what declaring means. Declaring is when the company says, we're going to pay dividends, in September or whatever. And say, okay, we're going to pay dividends of $1 a share or whatever it is. So a company can declare to pay dividends and then they must pay them. But a company could also say, look, we had a bad year. We can't pay any dividends. We're not going to declare any dividends. So if they don't declare any dividends, they're not required to.
Thank you.
Yeah. But yeah, so is the declaration of it. That I just should make that more clear on this. The declaration. So they could say that they're going to pay dividends. If they do say they're going to pay dividends, then they are legally required to pay the dividends. So if they say they're going to pay $1 for every share, if I have 500 shares, I'm going to be expecting a check for $500.
Thank you.
But if they don't say, they say, look, we had a bad year, we're not paying.
Okay, got you.
Yeah, so they're not required to pay the owners. Now, notice that's different than rent, or it's different than paying utilities. You can't just simply say, well, we're not going to pay utilities because they're going to turn off your electricity. So dividends are not required to run the business. Paying out dividends, whereas paying for electricity, paying for rent and all this other stuff, that is required. Okay. Privately held companies may issue financial statements. We'll talk about financial statements. Financial statements are what we're going to use to kind of put things in order. Privately held, if you're a privately held company, unless somebody else is asking for financial statements, you don't have to put them out. Publicly held companies like IBM and Ford and Target and Walmart and all these companies, if they're publicly traded, they're required by law to issue financial statements. So publicly traded companies must issue financial statements. And these are the financial statements. I'm just going to talk about them really quickly, and then I think we'll take a break. And we'll come back and actually do financial statements. Okay. So the income statement, that is sort of like what we talked about earlier, revenues versus expenses. How much money came in, what went out, and what's left over. Hopefully more money came in than went out. Obviously, you want that to have that scenario. So that'll tell you how much income you made or how much profit you made on the business. Statement of retained earnings is a wacky statement. The wackiest one we're going to cover, and it's sort of like the owner's piggy bank. Which I know doesn't make any sense right now, but hopefully when we go through it, it will. And the balance sheet has all the stuff that the company owns, and it tells how it got that stuff. So, we have these buildings, we have this equipment, we have this inventory. This is all the stuff we have, and then it also tells, okay, how do we get it? How do we get all this stuff? Buildings just don't magically appear. They have to come from somewhere. So where did they come from? And the statement of cash flows, we're not going to cover in here. It's a pretty complex statement. It is required, but it is not, we're not going to cover it in here. It's the newest of the statements. These first 3 statements are 500 years old. You can look at these, you can look at books for, businesses from 500 years ago, and it doesn't look that different than what we do today. This is a fairly new one. This is the youngster, and it's like 40 years old. So this is it's still kind of an old statement, I guess, but it's the newer of, it's the newer of them. But anyway, this one we're not going to cover in this class. And just because it is complex, and you also have to know quite a bit about these before you can even make this statement. So it's a difficult one to do. It's not impossible. I mean, people do it every day, but it's, anyway, it's one we're not going to cover in here. Okay, so I think we'll take a break. And when we come back, we will start in on this one, the basic financial statements on page 2. So let's take a break. Let's come back. What time is it? 6:55? No. Back at 7, say? Walk around. What do we want, 5 or 10 minutes? Which one?
10 minutes.
10 minutes? Okay.
10 minutes.
Okay.
10 minutes.
Okay, so I'll say be back at 6:55. So we'll say 7.
No problem.
Okay. Okay, very good. Okay, so what we're gonna. So what we're going to do is start in on page 2 of the. Handout. Go back to sharing my screen. And basically what we have is we have these, all these accounts. So these kind of like the accounts we talked about before, the definition. When cash came in, you'd mark down, okay, a list of, here we have a cash, we got an additional $20 of cash or whatever it was. So these are the amounts that are in these accounts. Now, looking at this list of accounts, it probably doesn't make a whole lot of sense. I mean, okay, you see how much cash they have, but what's this other stuff mean? It's not very meaningful, to see these this list of accounts. So we're going to put these in a format in the financial statements so that people can make sense out of them. So, just giving a list of accounts with totals is probably not very helpful as far as seeing how well the company is doing. So what we're going to do is we're going to do our 3 income statements, 3 financial statements, the income statement, statement of retained earnings, and the balance sheet. So these are the 3 financial statements we're going to do, and we're going to do them together. And we're going to fill in these little spots here. Now, if you're doing this on notebook paper, you don't have to write all this down. You can just write, the financial statements. You don't have to do the whole. I know what this stuff is. So if you just write it down on the income statements, the financial statements part only. Okay. So income statement. Income statement, we compare the money coming in versus the money going out. And does anyone remember from the definitions what do we call money coming in?
Revenue.
Yep. So this is money coming in. So we're going to put revenues down here. 4,000. And money going out are going to be these expenses. My camera's in my way. So this is money going out. This is money going out. Again, if this it seems unusual, it should be the first time you've seen it. Okay. So rent expenses money going out, salaries expenses money going out. A. And so we're taking 54,000. That's the money coming in. These are 2 going out, and we're going to see what's left over. And what's left over, the owners get to keep. Time for Mr. Calculator. My calculator cam. All right, so 54,000. $24,600, I think. You want to check that. I do make errors. Yeah, okay. So this let's change that back. So that's our net income. So this place was profitable. They made net income of 24,600. I got a question for you. Just looking at this, which number is probably the most important here? We have revenues, we have expenses, and we have net income.
Net
I think
income.
it's net income.
Net income.
Yeah, the income is what you.
Income
A
is.
lot of times you'll hear in the news, they'll talk about revenues. Oh, their revenues went up by this or whatever. And probably because it's the biggest number on here. But the fact of the matter is revenues are not really the important number. The important number is how much of that you can keep. You know, if you're making 54,000, you're paying out 60,000, that's not good. Okay. Okay, statement of retained earnings. All right, so
Retained earnings 30,000.
yeah, exactly. So the account we're going to start out with is retained earnings. Now, here's the thing. So the beginning retained earnings is $30,000. All right, I'm going to switch cameras here for a second. No, I'm not. I'm gonna keep the same camera. I'm gonna stop sharing. So it's sort of like this. So I tell you that retained earnings is, it's sort of like a piggy bank. It's a piggy bank for the owners. So here's my piggy bank. All right, so basically, net income goes into the piggy bank. And then the owners, though, will take out dividends out of the piggy bank. So net income goes into the piggy bank. Net income, earnings and net income are the same thing. So we're going to say that, you know, that's why this retained earnings is really retained income, same thing. But income goes into the piggy bank, and then the owners will take money out of the piggy bank. Now, notice, if there's nothing in the piggy bank, the owners can't take out any dividends.
Mhm.
This is zero. You know,
That's it, yeah.
you can't take anything out of it. So it's sort of like a piggy bank in that, you know, it's whatever's in there they can take out, but only if there is something in there. Okay, so let's see here. Share screen. Okay, so we are going to add in our income. Into the piggy bank.
It's 54,000.
So that is the same number as, no, that's this.
Mhm. You put 24,000.
Oh, I put the wrong number. All right.
It should be 24,600.
Yep, very good, thank you. Yeah, so that net income that's going into the piggy bank. Now they're taking money out of the piggy bank with the dividends. Here.
Mhm.
So this is money the owners are taking out. And this will give us our ending retained earnings. Oops. Time for Mr. Calculator.
So 30,000 plus 600 minus 52.
Yep, that's what I got. So 52. So that is the ending retained earnings. So that's how much is in that piggy bank. So it's sort of, so going back to this thing, you know, it's sort of like this. We had 30,000 in the piggy bank. The owners put in, was it 24,600, I think? Got added in, and then they took out, you know, so how much is in our piggy bank? Well, they added 24,600, just like we did at state retained earnings, then they took out that, and we ended up with 52,200. So this goes into the piggy bank, and this goes out. Hey, look, the piggy has glasses, just like me. Oh, and he's happy. All right, that'll be on the test, you guys. You guys have to do that on the test, so. All right, so let's get back to the. So it's certainly it's okay. So in going into the future, the most money that they could pay out for dividends, 52,200. You know, they can't pay out more than that because that's all that's in the piggy bank. Okay, let's go down to the balance sheet. Weird with the formatting of these. Maybe make it smaller. Okay, so the
Cash. Equipment.
yeah, let's come up here. So the assets we have will be, and you just said them. Cash and equipment. So these have a value, these have a value. The accounts payable, we'll talk about that in a second. This is what we owe to other people. We have to pay them, it'll be a payable. So we'll put these two in though, cash and equipment. Cash has a value. Just that quick, I forgot.
Equipment.
12,000.
Cash. 12,000.
Equipment. 8,000. So way down here, now, you know, a normal company, they may have hundreds of accounts here, but we just have 2 for right now, which is fine. So it's 60,000. So this is kind of the, how much stuff do we have? We have 60,000 worth of stuff. So we have cash, 12,000, we have equipment for 48,000. And so we have a total stuff of 60,000. The question is, how did we get it? You don't, you know, cash and equipment just doesn't appear out of nowhere. It's got to come from someplace. The question is, where'd it come from? Okay, well, one of the places it came from is that we actually borrowed some money here.
That's good.
So we have this accounts payable that, you know, and the key word there is
Liability.
payable.
Payable. It's
We have to
liability.
pay that out. We have to pay that to somebody else. So that's going to be a liability. And the liabilities are virtually all of them are going to be payables of some sort. So whenever you see pay a bill, that's a liability.
Total liabilities, 2,000.
Yeah, total liabilities are gonna be 3,000. If you only have one liability, you probably don't need to do the total, but
Equity, common stock. Common stock.
okay, so we owe 3,000. Now for the,
Equity. Common stock.
yep. One column here, so common stock of
800.
4,800. So this is stock that we sold to someone in the past. It could have been sold last year, it could have been sold 100 years ago. And this is the tricky part now. We also have the, let's get something here. I'm just gonna move these down to get on the same page. You don't have to do that. But
Liabilities.
they also have this ending retained earnings is also for the owners. Now, this is important. This is the ending retained earnings.
Okay. Ending retained earnings. So this-
So the ending retained earnings comes down to this equity section. Again, it's the ending retained earnings.
Okay.
Those two together is what, 57,000?
Yeah.
57,000. Total liabilities, 3,000. So it's total 60. So liability is 3,000. Mhm.
Professor, can I ask a question, please?
Mhm.
Equities, they are assets, right?
But one more time?
Is equity an asset,
No,
a liability?
no, it's actually what the
Oh.
owners own of it. But you asked a very good question. Here's what the equities account is. It's how much of these assets are owned by the owner.
What's the total? What's the?
So somebody else owns 3,000. We owe somebody $3,000. So of these assets, somebody else is going to get 3,000 of them. But the rest of those were owned by the owners. So this, what this really does, and why this comes out to, this is always going to equal. Oops, I'm gonna do this. It's basically saying, okay, you got 60,000 worth of stuff.
Mhm.
Where did it come from? It has to come from somebody. So in this case, they borrowed 3,000. So 3,000 of that 60,000 worth of stuff they borrowed. And the owners kicked in the other 57,000. So this whole financial statement just kind of explains how did you get these assets? You know, this is a list of the assets, all the stuff that has value. And this other side, these two just kind of explain where did it come from. And again, either the owners had it or they borrowed money. You know, that's the only two places they could get it from. So either they borrowed the money or the owners kicked it in. So this side really just explains where it came from. And you'll notice something too, for instance, these retained earnings, these are not going to all be in cash. You say, well, why? Well, they're probably holding on to those retained earnings to reinvest in the place and to make it more profitable and all that kind of stuff. So, you can tell that some of these retained earnings are in this equipment, right? They have to be. There's 52,000 in retained earnings and 48,000 in equipment. So this is kind of just explains where this stuff comes from. So we have 60,000 worth of assets. How did we get it? This side explains where we got it. Borrowed 3,000, owners kicked in 57,000. Yeah.
Thank you.
Yeah. It is a little bit unusual, but basically, if you think about it, that what you'd have to, if you have all these assets, what would you have to pay out, and how much would you get to keep? That's kind of what the equity section is. It's like, okay, if we paid off all our liabilities, how much of these assets would we get? If we pay off the 3,000, how much would be for us? The rest of it, If it doesn't, if you go through this and it doesn't balance, the most common mistake is people will use the 30,000 from the account rather than the ending. And I'm going to make one more point, then we'll go on to the next one. But one more point, and that is, you'll notice that we have to do these kind of in the order we did them in. For instance, you can't do a statement of retained earnings until you have the net income. So you have to do the income statement first before you get to the statement of retained earnings, right? This has to come first because you can't make it without it. And then you have to do the statement of retained earnings second. Why? Because you can't make the balance sheet until you have the ending retained earnings. So you kind of have to do these in order. You can't just jump into the balance sheet and go, okay, I'll put it in the balance sheet. It's not going to balance because your retained earnings of 30,000 is not, it's not going to show the ending balance in. So you kind of have to do these, A first, B second, C third. And again, this gives a lot more information than, this. It would be hard to tell if they're profitable or what else just by looking at these accounts. It doesn't tell you too much. Whereas this, you can say, okay, oh, they're profitable. They made 24,600. The owners, they have 52,000 in their piggy bank. We owe 3,000. They got 60,000 of that. You can get a lot more information. We have one of these financial statements. So here I am, an owner, but I'm not in the business itself. Business is separate. I can look at this and I can say, okay, I know how my investment's going now because I got these financial statements, and it will help me decide about this investment, whether it's doing well or not. Okay, let's go to the second. And again, this should be, if this seems very unfamiliar, it should. This is the first time you're seeing it. All right. Well, let's take a look at number 4. And number 4, we have a couple new accounts. Where do these expenses go? Wages, utility expense. What financial statement?
This was gone out.
So what's these financial? Anyone?
Can you say that again?
Here comes.
Yeah, income statement. You're right. Income statement.
Statement.
Yeah. Okay. Now here's a weird one. Accounts receivable.
It's statement of written in.
One more time. Yeah. So accounts receivable. This is when customers owe us money.
That's an asset.
Yep. Yeah, this will be an asset. Not spelled that way, but okay. All right, I think I'm going to be quiet and give you guys a little bit of time. See if you can kind of work through this. Take, I don't know, however long it takes, and see if you can kind of take these and put it in here. If you're unsure of something, feel free to ask. But I think I'll give you guys a few minutes to kind of go through these. I'll put the solution up here in a little bit. But one thing about accounting, like anything else, is the old Socrates statement that learning is doing and doing is learning. For example, if I watch a lot of baseball on TV, does that make me a great baseball player? Obviously not. So just watching somebody do something doesn't really help too much, but actually doing it yourself. So see if you can figure out this one.
Yeah.
You got 7%. Come call your mama while your phone on the charger. Let her know your phone was dead. You was outside and your phone was dead. She don't think you was ignoring her.
Somebody has their phone unmuted.
Oh, sorry.
It's okay.
Now, camera.
Oh, wages expense. Why you put expenses on there? Expenses coming out. Oh, okay. I get it. I get it.
Okay, questions? Oh, wait, sorry, doing something else. Any question on that?
Yes, I have a question.
Mhm.
When I was doing the assets part,
Yeah.
why is accounts receivable an asset and not a liability?
Oh, good question. So accounts payable and accounts receivable are both similar in that they're, things are done on account. The difference being is that we're going to receive this money from somebody else. We don't owe this money. We're gonna receive it. So someone will be paying us $20,000 cash. The reason it's different than this one is we're gonna have to pay somebody this $1,250. So this is gonna be money coming in.
Mhm.
And this is money going out.
Okay.
Yeah. But yeah, they're very similar. They say it's only the one word, but so any time you see a receivable, it's going to be an asset. Yeah. So so it could be if it's rent receivable or revenue receivable, whatever it is. Whenever you see receivable, it's going to be an asset because we're going to receive it in the future.
Okay, thank you.
A big part of this class is just getting the normal nomenclature down. This is the what we call things. It's if somebody owed you $20,000, you'd know exactly what that was. Right? So just we tack these names on it that are not intuitive. Okay. All right. Well, I think we'll do this last one too, and then we'll see how to submit it. And that way we'll go away nice and clean. We won't have anything due next week from this anyways. This will be the only thing you'll have to turn in for this week anyways. And we'll start in next week on the practice exam and all that stuff. But we'll go ahead and do this. Financial statement here. I think we'll kind of walk through this one together because this one has some new stuff on it. And here is the new things. What time is it? You know what? I'm going to change my mind. I'm going to give these to you. I'll tell you what. We'll do the income statement together, and then I'll let you guys finish the rest of it. The only reason I do the income statement together is this cost of goods sold is a new one. So we'll get started together on the number 6, and then we'll do the income statement together, and then you guys can fill in the rest, and we'll go over it next week. Okay, and you don't have to turn this in until I'll change the due dates on this. Okay, so we have revenues of 41,400. Now, this cost of goods sold. This cost of goods sold is the tricky one. And that cost of goods sold is, that's this. The thing that I paid $12 for that was sold that left, that's what that 12,880 is. It's goods that have left the place. Someone came in and paid us 41,400 for them, but we no longer have this asset anymore. It's gone. So that's what the cost of goods sold is. It's those things that have sold. Now, it's good. We want to sell them, but we have to take those and say, look, okay, we don't have that anymore. This is, So cost of goods sold is going to be a negative. And then the utilities expense and repairs expense. Yeah, so this is the kind of tricky one. But if you think about this, instead of cash leaving the place, it's goods that are leaving the place.
$11,960.
11,960.
Mhm.
Okay, so that's going to be our income. Okay, and with that, I'll let you guys go. Although I'm going to also mention one more thing here. Notice that we have 2 payables up here. So those are both going to be
Accounts payable and
exactly.
mortgage.
Yeah, those would be both be liabilities. Yeah. So there's 2 of them now. So you guys can probably figure out what to do with that. But all that. So that'll be it for today. And this is not due. It'll be due. Yeah. Well, let's go ahead and change it right now. It will be due on. I'd like to give you guys a week. So we're going to go over this next class. And so I'm going to change the due date to the 17th.
9/17. Okay.
And
Thank you.
2. Yeah, so the oops, that's not that. And so now, not to put too fine of a point on this, but so if you're wondering, what is due in the class, if you go to submit handouts and exams, you just click on it and it'll tell you what it is and when it's due. So in this case, the Chapter 1 handout is going to be due on Friday, September 17th, which is a good 2 weeks away. We'll finish up next week so you can turn it in right when we finish it up. But this will tell you what the due date says. So if you're wondering, gee, am I missing something? Is something to do? If you go into the submit handouts and grades, it'll tell you what's there. Yeah. So see if you can finish this next week. We'll go over it, and we'll do that at the beginning of class, and then we'll probably do a problem or two, maybe the textbook. I'll have the stuff for us to go over it. And then we'll also have the practice exam, and then I'll send you exam, and that'll be also due week 3. So, any questions?
No question.
Okay. You had enough of this, have you? Okay. Don't blame you a bit.
Will this recording be available today, or when do you think it'll be up?
It usually will be up around, it should be up around, hopefully by midnight. Now, having said that, it's fully dependent. It takes about once we stop here, it's going to take about an hour to render. And then I got to go in and edit it, because if I leave blank spaces in there, YouTube won't closed caption it, which is required by the American Disabilities Act. So, it'll render it. So it renders after I close this. It renders after I edit it, and then it goes to YouTube, which also renders it. hopefully by midnight it'll be up. I can't promise that because of the YouTube end of it. I know, you know, how long it takes them. Sometimes it takes them 15 minutes, sometimes it takes them 6 hours. So, you know, and I don't have any control over that part. But anyway, by the end, certainly by tomorrow, it'll be up.
Okay, thank you.
You're welcome.
How many exams does this class have?
It's probably gonna have. It usually ends up being like 7. Let's see. Look here. There's an exam after basically every chapter here, and we usually, I think I combine these two. 7 and 8 are combined, and so 1, 2, 3. I think yeah. So this will be probably somewhere around 7 or 8, just depending on what we get through.
All right, thanks.
And again, they're short. They're short. You know what I mean? They're not. They aren't huge ones. So, and that's by design. You can learn better that way, or more. I should say, most people learn better that way. Any other questions?
No, thank you.
Thank you guys. Okay, well, I will see you guys next week. Nothing is due this week, and we'll take a crack at that. Don't be afraid to make a mistake. And it's the first time you guys are seeing it, so if it's unusual and strange, it should be the first time you're seeing it. But we'll go over it then next week.
Thank you.
All right. Good night.
Have a good night.
Thank you. Have a
You
good
too.
weekend, everyone.
You too.
All right, bye.
Bye.
Yeah. Save that. Save that.
Okay, thank you. Bye.
Bye. Bye. Bye.
Bye.